gold has hit $3,000 an ounce. The Federal Reserve doesn't have a clue, but this is a harbinger of why it is headed for an existential crisis. Hello, I'm Steve Forbes, and this is What's Ahead, where you get the insights you need to better navigate these turbulent times. The Federal Reserve thinks it has inflation under control because of recent encouraging readings of various price indexes, and that interest rate cuts can resume once it gets a grip on the impact of President Trump's ongoing tariff actions. The rise in the price of gold, though, tells us the opposite is true. Future inflation is brewing. Amazingly, our central bank really doesn't understand inflation, and this ignorance leaves it unprepared for what lies ahead. Monetary inflation is reducing the value of a currency, usually by creating too much of it. Non-monetary inflation is triggered when prices rise because of disruptions to production from natural disasters, wars, the pandemic lockdowns that severely disrupted supply chains, or expense-creating government regulations and certain increases in taxes. The Fed can't control non-monetary inflation, but it can control the value of the dollar. For a variety of reasons, gold keeps its intrinsic value better than any other commodity and has done so since recorded history over 4,000 years ago. It is the best barometer of monetary trouble. A sustained rise in price foretells inflation. A fall in price, deflation, that is, a shortage of dollars. When the price of gold fluctuates, it doesn't mean the value of the yellow metal is fluctuating. It's the value of the currency that is changing. This distinction is crucial, and it is lost on the Fed and almost all other economists and central bankers. The advance in the cost of gold, if not stopped or reversed, means future inflation, because it says the value of the dollar is moving down. Unfortunately, the Fed ignores gold when it comes to monetary policy. Even before the COVID crisis hit in early 2020, our central bank was undermining the value of the dollar. The yellow metal swelled from around $1,200 in late 2018 to the $2,000 range in early 2020. In other words, a serious surge of monetary inflation was already baked in when the lockdowns began. Without realizing it, the Federal Reserve is making the same mistake again. Gold has moved up over 60% since mid-2023, when the Fed had been ostensibly fighting inflation by jacking up interest rates. The Fed's profound flaw is that it thinks prosperity causes inflation, that there is a trade-off between unemployment and inflation. You want less inflation, you must slow the economy. It doesn't take proper account of price changes from non-monetary factors like lockdowns or permanently higher tariffs, and what happens when you let the dollar fall in value. If the dollar price of gold doesn't seriously recede, or in fact continues to move up, then inflationary storms do lie ahead, and the Federal Reserve will respond by trying to dampen the economy. This will trigger a big political backlash and attacks on the Fed's very existence in its current form. I'm Steve Forbes. Thanks for listening. Do send in your comments and suggestions. I look forward to being with you soon again.